Hey guys, what's going on? It's Henry, and in today's video, I want to talk about selling puts versus put credit spreads. I'm going to talk about these two strategies. I'm going to basically help you master both of these in this video because both of these are my two favorite strategies. The strategies that I've used to grow my portfolio from $7,000 into over, 1.799 million at this point. I'm going to talk about opening and closing trades. I do get a lot of questions about that in my private Discord community. How do I open this? What is the correct strike to pick? What expiration do I pick? And then once you're in the position, how do I manage this position? How do I actually close this position? Now, this is really important for growing a small portfolio. And I know a lot of people out there are trying to grow a small portfolio. And to be honest, one of the best ways is going to be through spreads. So this is going to be the most helpful video that you can possibly watch about growing a small portfolio. And by the way, if you're trying to grow your own portfolio, I do have a challenge that's taking $7,000 and turning it into $17,000 in my main Discord. So that's where I'm going to be making trades on Mondays and Wednesdays and doing that live so you can grow your portfolio with me together. The main Discord is literally where I spend 100% of my time and focus on, so that is where students get the most results. If you want to join that, it's the very first link in the description. I'm going to show you hands-on how to take your portfolio from 7K to 17K. Last year in 2021, I was able to take 17K into 13.5K. So I didn't quite hit my goal, but I did really well. I basically almost doubled my money, even during some of the tough times that were happening last month in August. And we just wrapped up in August, and I just started the new challenge. So make sure that you sign up so we can work together on this. All right, so what is better, selling a put option or a put credit spread? So both of them are very good, and it just depends on the specific situation that you're in. I do have a lot of this. As you can see, I have NVIDIA right now that I sold a put on, and then I also have some positions where I sold put credit spreads. Granted, not as many put credit spreads at the moment. I do have a lot more puts that I'm selling. I'm up $4,600 here. So I do prefer selling put options at my point, but I'm also going to show you put credit spreads first because I want you to master put credit spreads. Once you master put credit spreads, that's how you actually grow a smaller portfolio. And then when you get a bigger portfolio, that is when you would prefer to sell put options. Now, there's a very important difference, okay? They're very similar actually, although one requires a lot of money and put credit spreads, well, they don't require much money at all. In fact, probably like, $100 or $300, very little amounts of money. But actually, they're not that far off. But let me show you first what a put credit spread is. I'm going to do this on NVIDIA. Specifically, I want to use NVIDIA because this stock is a very high growth stock, but it just went really, really bad for investors. I mean, essentially, this stock was way over $200 per share, and even $319 per share. And then it's been in really, really bear territory. But recently, if you take a look at this stock is down to like $140 per share. So I do have a couple positions here. I'm actually up $255, but I want to show you a put credit spread on NVIDIA. And essentially, a put credit spread, don't get confused. It's actually a really easy strategy. It's just two different option legs. I'm going to show you exactly how to do that. So let's go to trade NVIDIA options. And the put credit spread will say that I don't think NVIDIA is going to fall too much lower. So currently it's at 140. This is basically as low as I can see NVIDIA. Maybe it can go to like 130. So let's do a put credit spread. I'm going to go for 1 week out. You can also do 2 weeks out. I like to trade between 1 to 4 weeks. That's when options are like the most profitable to sell. Now to buy options, they're probably more profitable to go like longer term. But to sell options, it's really short-term things that are going to be better. That's because these options are pretty much at their last whim. They're really close to expiration. And if they don't hit their strike price, then they're gonna be worthless. And if you're selling things that are expensive and then they become worthless, well, I mean, that's not really a bad thing in option trading. It's a bad thing in life, but it's not a bad thing in option trading. So the first thing that you want to do is you want to do sell put option. Okay, so I'm going to go down to 140. Now I don't think that this stock can fall too much lower. In fact, I think at like 130, that's really a good support and floor for NVIDIA. I mean, 130, I would see the stock as a huge bargain. Can it go down here? Sure. If I expand this option, there's a 18% chance of it going down here. I mean, you can see that by looking at the delta. The delta is 0.18, which is basically 18%. Now, I did say in yesterday's video that, volume when it's high is good. And this is extremely high. 9,000 volume, absolutely ridiculous. That's great. and the bid ask spread is so tight. It's like 2 cents off. That is fantastic. This is like literally the dream of an option trader. This is like the dream. This is like the best stock that you can possibly trade on at the moment, of course, with Tesla and stuff like that. But so let's go ahead and sell the 130. And if you'll notice, I mean, this isn't really good for small portfolios, and I'm going to show you how to make it good. But this is currently not that good. And the reason it's not that good is because, well, yeah, you're making a max profit of like 120 bucks. That's cool. But I mean, look at that max loss. It's really, really big. And you know, this is fine for bigger portfolios, and I will talk about that later in this video. But for a small portfolio, you might not have that amount just sitting around in cash. And I don't blame you, because I didn't always start off with money myself. I had like $2,000 at one point, then I added some more, I had 7,000, and then from there, I didn't really have a job because I was in college, so I had to grow it the hard way and basically just be successful. I didn't really have any income till I graduated college and then finally got a job, and that was actually not that long ago. So I did a lot of growing my portfolio without any cash flow. So if you have a job or some cash flow, you are gonna have a lot more power than I had. So anyways, let's go to buy put option. So now it's 130, and I'm going to protect myself, and I'm gonna go down to 125, okay? So by buying the 125, you'll see here that I'm collecting 120. That's cool. And now I am spending 55. However, this $55 is basically like insurance. Like I'm protecting myself if the stock were to fall below 125. And because I'm fully protected, if it were to fall to 125, I really don't have that much risk. My only risk is what happens in between 130 and what happens at 125. So in the middle, yeah, I would lose some money. But again, I don't think that Nvidia is going to fall down to like 130. And if it does, I mean, it could happen, right? But unlikely. And this position right here is going to make a total credit. Now, this is really, really important. I had students that, you know, they have made debit spreads. A debit is like when you pay money. I don't prefer that. I grew my portfolio by selling put credit spreads. I'll show you specific examples actually on exactly what I did. It wasn't exactly Nvidia. I did something else, which I'll show you in a second, but this is an exact example on a different stock. I mean, I sold put credit spreads like this. Here's $65 that I'm collecting. This might not seem like a lot of money, but I mean, $65 is in relation to the collateral that I'm putting up, and the collateral is only like $435. The reason it's $435 is because, well, this is a $500 spread, but because I'm collecting $65, it's really only a $435 spread. So I mean, if you take $65 and you divide it by like $430, you are making probably around 20% return in just a week. So as you can tell, you don't really need to be that consistent with this. As long as you do this like 2, 3, 4, 5 times in a row, sometimes you can have a small loss, but 3, 4, 5 times in a row, like 5 times in a row is going to be over doubling your portfolio. So that's how I actually grew my portfolio from like starting at 7K, right? I mean, that's pretty much my beginning of my journey. It was 7K, and then I grew it all the way up to 70K in a single year. And that's because I kept like doubling and doubling and doubling. And granted, it was good times. I mean, I was in a bull market, so it is important to be in a good market. Like, good strategies are great, but you still need the market to be kind of on your side, which is why I'm going to talk about risk management in just a second. But essentially, this is the perfect strategy that I use to grow my portfolio. Now, like, let's talk about risk management. So it's really important not to open up your entire portfolio full of spreads, okay? That's why I'm also talking about puts in this video. So essentially, you can open up spreads in your portfolio, especially if you have a small portfolio. You can, you know, open up like 30 or 40% of your entire portfolio in put credit spreads. But still, keep in mind, if the market does fall, all stocks are going to fall. And if all stocks are going to fall, a put credit spread is going to get hurt. For that reason, I don't like to do an entire portfolio full of one strategy. I like to completely mix it up, so my portfolio has basically 5 to 10 strategies. Those strategies are obviously the ones that I talk about in my small account playlist, which you can always watch by going to my playlist or checking out the description. I have a full playlist, and basically I like the strategies that are like leaps, covered calls, selling puts, put credit spreads, and call credit spreads. Like, I have videos on all of these. Today I'm just focusing on put credit spreads, and specifically put credit spreads are like my favorite. I think that it should be, for a large portfolio, let's say that you should put about 5 to 7% of your money in put credit spreads on a larger portfolio. Now for like a medium portfolio, you know, that could be like 40K or 50K. Then, you know, you can increase that just a little bit. Maybe you can do like 10% of your portfolio. And then if you are at a small portfolio, say like $10,000 or less, then, well, you can actually go a lot higher, because, you know, $10,000, I know it's hard to, you know, save that up if you're a beginner, but still, I mean, you can go a little bit riskier, because losing $3,000 out of $10,000 learning this stuff and getting really good at it isn't really that big of a deal in the grand scheme of things. So put credit spreads, about 30% of your portfolio if you're having a small portfolio. Now, I do want to show you exactly what I did back in 2020 and 2021. So in 2020, I had some crazy returns. So I had like 100K, and then again, I ended the year at basically 700K. So I had a 7x return in 2020. Again, it was a bull market, but still, I mean, I can't just say it's a bull market and anyone can get lucky. You still need to have a lot of talent and skill in managing your position. And specifically, I did make a lot of money on Tesla. However, I didn't just buy Tesla and hold it like, a lot of people did get wealthy that way. But Tesla, even in like 2020, right, it didn't go up that much. I mean, in 2020, it started off at $31, and then at the end of 2020, it did go up 7x actually. That is pretty insane. So yeah, I made around a 7x return, but my portfolio was not fully Tesla. So I was still able to get a Tesla return on my entire portfolio. However, I was only like maybe half Tesla. So I should have only had a 350% return, but I was like a little bit over 700. I started not even at 100, I was probably around 90 something thousand. And then I ended at like 750,000. So I still beat Tesla, but wow, I didn't actually know Tesla went up that much. So yeah, it makes sense. So if I go to trade Tesla options, I'm going to show you exactly like what I did. So as Tesla was rising, I could have just held the stock, right? But I wanted to make a little bit more money. So what I specifically did was actually put credit spreads. So I would do like weekly spreads and like, every 2 weeks, so semi-monthly. So for example, I would go to like September 16, which, again, doesn't matter if you're watching this in the future. I would just do a 1 week option. And then like, for example, like let's say that Tesla's at 289 and I was really bullish and I was using like technical analysis and I would say, hey, this stock's gonna continue rising. So what I would do is I would actually sell puts very close to the money. This is an aggressive strategy. And what I mean by close to the money is like stocks at 190, right? I would sell like something really close to the money. So it would be like 285. So I would end up selling the 285 and then I would buy another put option again to protect myself at like 280, right? So this is a $500 spread. I really like $500 spreads. They're super easy and they're manageable for like small accounts. So, I had not a small account at that time. That's why I didn't go 100% Tesla. I had like 90K. And for that reason, I was going like 40K worth of put credit spreads, which again is aggressive. I mean, it's definitely aggressive. But here's what I did. So basically I would do slightly out of the money like this. And yeah, like my max loss was higher than my max profit. However, I'm, creating some cushion. I'm a little bit out of the money and I would collect like $155. And basically I would risk like, roughly what, 350. So this is about a 50% return. And, I would do this on a weekly basis. So if you do this weekly, basically 50% and then another 50%, that's like double in 2 weeks, and then another 50% and then another 50%. I mean, you can definitely like take your portfolio into like 3x territory in a month. However, obviously, 3x territory in 1 year per month would be like 36 times your portfolio. Obviously, I did not do that, just being honest with you. Like, not all the time does this position work out. And that's where we have to talk about closing. So closing is obviously a very important part of trading. Like you have to know when to close. And that really depends on the position. So for Tesla, I mean, I would basically hold this stock. I would look at a few things like candlestick and momentum and like RSI, all the things that I teach in my Discord community, like exactly how to, be really good at technical analysis. So you make way less mistakes and understand what the stock is doing and why it's doing that. So for me, I would actually cut the position if it would hit my strike price. So really simple. If Tesla was going up, great. If it was going down, that's fine. But if it were to hit 285, I would really look at certain indicators and say, hey, is it time for me to cut this position? And honestly, more than half the time, I would cut the position. So I was making really good returns and most of the time I was fine because again, we were in a bull market. I was managing my position well and I was picking like one of the best stocks in the entire market. I mean, Tesla has amazing volume. Tesla has amazing open interest. The bid-ask spread is really tight. So, I was able to take 90K into like 750K in 2020. So I did fantastically well, even though I had sometimes a losing position. I would close a position for a slight loss or, honestly, I can't lie, I've had the position lose like the entire amount. But still, it doesn't matter because I was properly diversifying and I wasn't investing just in Tesla. I was doing put credit spreads on Tesla. And here's another secret. And not only was I doing like 285, 280, for example, but then I would also go down and do another put credit spread at 275, 270. And then I would go a little bit more down and go at 265, 260. This is called strike diversification. So I was going through strike diversification and I was betting that Tesla won't fall and I would pick different strikes because sometimes it would fall a little bit, right? And one of my put credit spreads wouldn't do well, but still the other 2 or 3 would do well. So I still did really, really well in terms of 2020 returns. Now, I do want to talk about selling puts as well. Selling puts is a little bit more of a big boy game. However, there is ways that you can sell puts with little amounts of money. And one way that I would do that is I would look at stocks that are cheaper. Now, I wouldn't go for penny stocks because you still need volume. I still really recommend that you pick stocks that have over a $2 billion market cap. You can see that right here. This is a $9 billion market cap. And that's basically because I want to make sure that the stock is liquid. It has good options, that it has good volume, it has good bid-ask spread, but you can still sell put options, which is my favorite strategy right now because it is less risky than put credit spreads. A put credit spread, you can lose the entire collateral. However, with selling a put option, you really can't. If you like that stock and you're gonna just buy it, right? When you sell a put, you're obligated to buy if it goes down. I mean, that's not really a bad situation to be in. Let's say that you sell the 13 put American Airlines. If it goes to 13, I mean, it's not the end of the world. That's not that bad of a thing. You can just hold the stock. I mean, me personally, you can see that I sold a 14.5 put. And yeah, the stock is a little bit down at $810. But Robinhood isn't showing all the premium that I've collected. I'm actually still up on this stock. So although it says that I'm down, I'm actually still up on it because I've sold so many options. Like I've sold puts like maybe 8 times before I finally got put. And all those 8 times I collected like 1 or 2% premium. So, 8 times 1 to 2% is between 8 to 16%. So I made 8 to 16%. Sure, I'm down right now, but I mean, I made way more than this 3.7% loss. So that's why I like selling puts. It's really consistent. And I have a student that has been doing $5,500 a month for like 8 months. He is retired. He does have a little bit of a larger portfolio and he uses his money to live on. I think he has like $250,000, but he's making $5,000 a month. That's fantastic. And he's super consistent with it. It's not $1 million a month, but it's $5,500 a month every month for 7 months. That's exactly what my hope is for my students. I want them to be consistent and have consistent returns, not necessarily swing for the fences. I don't like buying options. I like to stick to consistency. Therefore, everyone's happy. They can actually use this money to live a better lifestyle, reinvest that money, or what have you. I just like consistency. I don't want to be stressed and seeing my portfolio go up and down by like 30%. I prefer my portfolio going up by 1% a week. That is my goal. And selling puts is more consistent on that. If you want to watch a video on selling puts, you can check out this video right here.